The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon to everyone on the line. Welcome to today's webinar on the ACA. My name is Matthew Darius. I'm the Professional Development Coordinator here at New York ASBO, and I'll be moderating and running today's webinar. Let's get a few things out before we introduce our speakers. If anyone has a question for our presenters today, there's a couple ways you can go ahead and get those answered. You can use the chat window on the GoToWebinar control panel. Just go ahead and type in your question. There's also a question and answer pane, which is the preferred method of asking a question today. Go ahead and type it in, and it allows us to keep track of the questions and get you answers easier than the chat window. So we prefer, if you have a question at any time during the webinar, go ahead and type that in and we'll get that answered for you. I'm going to turn things over to Deborah Cunningham, who's going to do a brief introduction of our presenters. Deborah?
Thank you, Matt. Good afternoon. Welcome to this New York State ASBO Hot Topic webinar on Affordable Care Act reporting requirements. I am Deborah Cunningham, New York State ASBO's Director of Education and Research. And this is a hot topic because did you know that the deadline for getting people started on health insurance is less than 2 months away in October 2015? And that the IRS reporting deadline for employers is January 1st, 2016? And that employers will have to furnish the IRS Form 1095 to their employees on the same timeline as W-2s in January 2016 for calendar year 2015. And did you know that the law includes hefty penalties for failing to report timely? The time to act is now. New York State ASBO brings you Michael Grinnell and Kirsten Tubman, Vice Presidents at CPI-HR, for a lively and informative discussion that will help you to complete requirements as efficiently as possible. Mike and Kirsten have followed the Affordable Care Act since its inception and have lobbied both federally and statewide concerning its implementation. They specialize in helping employers navigate this ever-changing law. So welcome, Mike and Kirsten. The floor is yours.
Okay. Welcome, and welcome, everybody. We're going to try and keep this to within an hour. We have, to start off, we've got policies and procedures. One of the things that, for those of you that have seen us speak before, what you're going to be looking to have to do is, number one, you've got to give out the notice of exchange to all your new hires within 14 days of hire. You have to distribute your SBCs, or your summary of benefits coverages, annually. And one of the things that you're going to be audited on as well is your ACA plan affordable as defined by the law to employees? Have you set up a tracking policy or procedure? What measurement period are you using? What administrative period? And what stability period are you using?
The biggest thing, really, like Mike said, policies and procedures, you're setting up to cover yourself when you get audited. We're going to get to the reporting because that's a huge find this year, but you also want to make sure that all your back-end policies and procedures are put in place. The ACA audit team is going to come out and start auditing. They're training now, and it's going to be similar to a DOL audit. You'll get an advance letter, and they're going to come out and they're going to look at all these things that we're talking about, make sure you're following the law. One of the things that you do need to think about, and we'll get into tracking some more, is assigning hours to your coaches and your stipend employees. So once we talk about tracking, you'll understand that a lot more, because no longer can you just give your soccer coach a lump sum of money and tell him to go coach soccer. You need to define all of that.
Yeah, and one of the things that we have seen as we've been looking at the payroll systems with the districts that we work with, typically on the payroll systems, whether they're WinCap or Finance Manager, you'll see that they assign 1 hour, and that is just to cut the check for these stipend employees. So one of the things you need to do is change that back-end system to whatever you come up with for hours for that stipend, that it should be recorded in your payroll system.
So what we're talking about here is tracking your hours. So that's the first step of seeing who you have to offer coverage to. So before you even report to the IRS in January, you have to make sure that you've offered coverage to all of your eligible employees. So you track all of your variable hour employees. So if you're thinking of this, you take everybody who's offered benefits. You need to do affordability testing on that, and we'll talk about that a little further in another slide. Everybody who isn't offered benefits, you need to track their hours. So you have to set up a tracking policy, and you have to have a look-back policy for everyone. And this really took place for 2015, your renewal. There's some transitional relief that goes into effect, so we're mainly concerned about the year 2016 policy beginning with our school districts, because most of you are going to qualify for transitional relief for 2015. So when you look at tracking, and I guess we're going to talk about reporting right here. The IRS reporting, when you end up doing that, you have to give your 1095s and your 1094s. Number one, you have to know if you're self-funded or fully funded. So if you're self-insured, you have a lot more reporting requirements than if you're fully insured.
And for those of you that are on NISHIP, NISHIP is a self-funded plan, so you would be required as a group to do your 1094 and 1095 reporting.
And 1094 and 1095 is the IRS form number. So when somebody's saying, oh, are you following 6056 and 6057 of the IRS, those are code numbers. That's the IRS code. And the form numbers to complete the code is the 1094 and 1095. 1095 goes to each of your eligible employees, and 1094 is a transmittal that goes to the IRS. So when you're looking at this, the employee statement, the 1095, you have to provide this to each employee by January 31st. It follows the same timelines as your W-2s. So you have to send out your W-2s by the end of the month, January for calendar year 2015. So you're doing the same thing with these, and they're proof of offer of insurance. So if you're self-funded, remember you have to send it to all your plan participants, all your people that are on the plan. If you're fully insured, you're only required to send them to your employees, which means if you're self-funded and you have people that are on COBRA, or you have under 65 age retirees, all of those people get a 1095 at the end of January for 2015.
And some of the things that you have to be thinking about as you're getting ready to do your reporting, the 1095s, as Kirsten said, come out at the end of January. But then you have the 1094 that comes out as a transmittal at the end of March. Well, you have to do your accounting. You have to pull your reconciliation lists on your membership files and make sure that when you're reporting this out that you have all the dependents correctly checked on their box for the months that they were covered. So we're now almost 9 months of going back and tracking data to see who was covered and when. A lot of the times you can get some of this information from your carrier, and I know one of the things that we've encountered with NISHIP is NISHIP will allow you to go retro back to 6 months. A new standard should be inside your organization that as soon as that event happens, to get it done. Instruct your employees to get you any changes as soon as possible. And then the other thing we got to think about is, no doubt in December of this year there's going to be some change that takes place. Either there's going to be a birth, there's going to be a divorce, there's going to be some change for one of your employees that you won't find out till after potentially the 1095s have been issued.
Mike, we have a question.
Sure. Matt?
This is from Kathleen. If we have full-time employees that have decided to decline the insurance benefit, do we need to provide a 1095 form to them as well?
Yes. You will provide the 1095 form to anyone who is offered minimal essential coverage. So somebody comes on, they're full-time, they decline, they take a buyout, they don't take a buyout. For whatever reason they decline, you are still going to issue them a 1095. You're not going to have any of the boxes checked that show that they have coverage. So you will, and I'll show you a copy of the form. So if you look at this form, 1095, you're going to see line 24, 23 and down has lists for all your people that are covered. So you would issue that person one of these forms. The top portion would be filled out saying that they were offered coverage, and none of those boxes, January through December, would be covered, showing that they have coverage. The reason for this is when they go to do their individual taxes, it's going to show that they were offered coverage, so they are not going to be eligible for a subsidy on the exchange.
And this is Deborah, I have another question asking for clarification. Did you say the 1095 only has to be sent to employees and not retirees?
No, if you are self-funded, the 1095 is going to all your participants on the plan. So anyone who's covered on the plan or employees that are offered the plan. So in the case of a self-funded, if you have employees that are under 65 that are on your plan, or retirees that are under 65 that are on your plan, they're going to get a 1095, as well as those that you offered coverage and they declined it. If you're fully funded...
Well, let me jump in. There's one more exception there. All your COBRA enrollees as well on a self-funded plan will be getting those notices as well.
If you're fully funded, then you are only responsible for your employees. So you're fully funded, you only send these to your employees that are offered coverage or are on the plan, and not anybody else. So when you look at this, the different forms, the 1095s all go to the employees. You're going to hear out there 1095B, 1095C, 1095A. That's just who's responsible for which form. So 1095A would come if somebody's on the exchange and they get a form. 1095B comes from small self-funded. All of you are going to be doing 1095Cs, assuming that you're all large group school districts, which is over 50 full-time equivalents.
Kirsten, we have another question.
Sure.
Joe would like to know if Medicare recipients do not get a 1095.
They will be getting a 1095 from the government when they're covered by Medicare to prove that they have coverage.
Okay, thank you.
Mm-hmm.
So as we said here, you're looking at the 1095Cs. You have to do an affordability check because in Part 2 there, it's going to have the minimum amount that you charge for a single coverage to an employee. So you don't put in that box the total premium or even what they actually take, because affordability only has to be affordable for the single coverage. So even if somebody's on a family coverage and has your highest plan, you're only going to put the lowest plan that they can get and the single cost for that.
And as you're completing this form, one thing that you have to keep in mind is, as we've worked with school districts, we find that in some contracts there are a given date for new hires. They get a different contribution. That has been a strategy of negotiating contracts. So you'll have several different employees based on hire date that will have a different contribution inside that box. So you got to be mindful of that and think through that. The other thing that, go ahead.
I just got another question if you want to finish your thought there.
Okay. Well,
okay.
Nope, go ahead. I can go back to it.
Okay. The question from Michael is, what is the difference between self-funded and fully funded? If you would just cover that briefly.
Yep. Fully funded means that a carrier is at risk for your premium. So you are just paying a premium, and regardless, you'll get assessed an increase, but they're at risk. They set a premium level, and they cannot recoup anything other than a premium increase on the renewal. So if you ran $1 million claim, they would be exposed to that $1 million claim. When you're self-funded, you as a plan pay those claims yourself. Now, NISHIP is, again, it kind of confuses people with NISHIP, and I bring that up because we've just talked to a lot of people about this. They do issue rates. However, in a circular that they released in April, they absolutely came out and said we are a self-funded plan as of January of last year, and we are not doing any part of the reporting. So again, the difference is who's at risk. A self-funded plan is the district would be at risk, and a fully insured plan would be the insurance carrier.
And if you're not sure if you're self-funded or you're fully funded, depending on what your role with the district is, you might not know. So whoever handles the benefits or shops the benefits should know. Again, if they're self-funded, typically they would have, not always, but typically they would have a stop-loss policy and a third-party administrator that's doing the claims. And if you're fully insured, you typically just pay, like Mike said, a flat premium. But ask whoever does the shops the benefits, and they should know, or you can just call your carrier or your third-party administrator and say, am I self-funded or fully funded?
But NISHIP would be an example of fully funded, is that right?
No.
No, NISHIP would be a self-funded plan.
NISHIP is an example of self-funded. All right, good.
Yep.
I think
Yeah.
district that.
Yep. If you are with NISHIP, you have to do employer reporting on all your participants. So you have a lot to do if you're with NISHIP or you're self-funded.
Now, we've also talked to some districts, and some of the confusion, I flipped back to the 1095B just to kind of focus on if I am in a fully insured plan like an MVP or CDPHP, and I offer those coverages to my employees, the carrier is going to send home a 1095 listing all the dependents. You as an employer are going to do a 1095, and you're going to fill out parts 1 and part 2, where you're going to put in the contribution piece. So you're going to issue a 1095C to them. And the reason for that is you have to prove affordability on that plan, where the carrier would not know how much that employee's or the minimum value contribution would be for a single employee. They don't record that information.
All right, Mike, I have a follow-up question.
Sure.
If this is actually a separate issue. If a retiree is covered by Medicare but his spouse is NISHIP primary, would we issue a 1095 to the retiree or the retiree's spouse, or neither?
You're going to issue it to the spouse because that's covered participant on your plan. So the spouse then would be treated as your, quote, employee, but it's really, when you're self-funded there, it's going to be participants on the plan.
Okay, well,
And remember,
I have 2 more questions for you.
Okay, sure.
If you're done with that one.
Yep.
All right, so this is from Mary. She asks, some/most of retirees who are on Medicare may still have health insurance through the school. These would be supplemental insurance secondary policy behind the primary Medicare policy. Would we still issue a 1095 form to this group of individuals?
For the 65 plus Medicare primary, you would not issue a 1095 for.
Okay, easy enough. And last one I have for now, it's from Tracy. What if our health plans are fully funded but our prescription plan is self-funded?
Well, again, the carrier is going to issue the 1095s, because I guess the assumption would be made in that instance that I couldn't just enroll in prescription-only coverage, so therefore me and my family would be enrolled in the fully insured medical plan, and they're going to issue the 1095s, and then you wouldn't have any other obligation other than you'd have to do part 1 and part 2 of a 1095C for all your employees that are enrolled in that plan.
All right, that's all I have for now.
Okay. And remember that if you're self-funded and you have people on your plan like your maybe directors or board members, you're going to be issuing them 1095s also. And we know that you guys are all over 50, well, most school districts are over 50 full-time equivalents, so this kind of just goes through what we're talking about filling out with respect to people who are not employees, but you still have to fill it out if they're participants on the self-funded. The penalties for non-compliance here are huge. This is the third one that down bullet. They just went up. It was $100 per day per employee for not providing those 1095s and 1094s. The penalty just went up. It was announced. It was actually President Obama put it in the trade bill to raise all penalties for no IRS filing, which this falls under. Simply just like your W-2s. You don't provide a W-2, that fee used to be $100. It's now gone up to $250. So you don't provide your 1095s, $250 per day per employee till you get them out to an annual max of $3 million. And then your failure to IRS report, that's your 1094s. Your 1094s you're obligated to do if you're self-funded. If you're fully insured, your carrier's going to do your 1094s. And I just want to go back to tracking for a minute because I know we didn't cover that deeply. And hopefully everyone is, there's no slide in there, everyone is already in the middle of their tracking periods. So for tracking, you have to set up a tracking period that goes through and says, you're going to track your employees for, you can choose between 3 and 12 months period of time. If you're all school districts, so even if you choose a 12-month period, you can only actually use 10 months for your 10-month employees. So you write your policy as a 12 months, but for those 12-month employees, you can track them for 12. For your 10 months, you can only track them for 10 months. When you track somebody, you're going to track by your look-back period. And this typically should have been in 2014, so you can prove your transitional relief for 2015. And then going forward, you're going to track people on an annual basis. And by tracking, I mean that you're going to look at each person's hours. And these are people you do not offer benefits to. So it's all your variable hour employees. You're going to look at their hours, and you're going to see if they average over 30 hours per week over your measurement period. So that's what the federal government is saying now is full-time and has to be medical benefit eligible. So if you're going to look through them, any subs, really the districts that we work with, we see the only big problems with school districts is when you have people doing multiple jobs. So if you have a substitute teacher who coaches wrestling and then coaches swimming, or you have a bus driver who does a lot of overnight trips, it's all the hours paid, compensated hours. So you have to add up hours if it's paid vacation or if they're paid during jury duty, anything like that. If it averages over 30 hours per week over your measurement period, then you need to offer those people benefits.
And again, one of the things that we have seen when we've been looking over payroll data and giving advice on how to assign hours, we see that, the subs will show up as a 1 unit factor in the columns as far as hours, and then there typically were per diem employees, so you paid them $150 for that day. The reality is whether your day is 7 hours or 7 1/4, whatever it is, you would need to have those hours reflected in your payroll system so that it's easy for you to calculate. And then obviously it would be if they worked 5 days a week for you, then that week they would absolutely be at 35 hours if your day was 7 hours. So you want to be able to measure that, track that, and so that you can prove that should one of those employees just fall short of qualification, you're able to point to it. I think what's going to come in the future is as more and more consumers get aware that they are eligible for benefits through their employer at 30 hours. There could potentially be, when somebody's health turns to the bad side, a lawsuit where you would be in a defensive measure of having to prove this. So getting your systems set up in place today will help you and protect you in the future.
We work with some districts who have...
Yep.
Oh, I have two questions for you.
Sure.
One's from Lawrence. We thought they would not be getting the 1095 unless they hit the 130 hours for that month. Is that true?
Right. The only people who are going to get the 1095s are those who are offered or should have been offered coverage. So, yes, you're not sending them to your people who do not average over the 30 hours. So you're only sending them to those who have an offer of coverage. Because remember, these forms are for people to take when they get their taxes done next year. This year, when you guys went and got your taxes done, or you did them yourself, there was a page there that said, have you had coverage for the last 12 months? You check the box, yes, I've had coverage. The rest of the world checked the same box, and that's why we've spent so much money on subsidies, because we have no proof of who was offered coverage and who should really get a subsidy on the exchange and who shouldn't. Next year, when you do your taxes, the same question is going to be there. Have you had coverage the last 12 months? But you're also going to have a 1095 to prove you've had coverage. So those people who don't qualify for coverage aren't going to have one, and those are the people who are going to get a subsidy on the exchange.
Right.
You had another question, Matt?
Yes. This is from Laura. If a retired employee has Medicare coverage, then we do not have to. If a retired employee has Medicare coverage, do we need to prepare a 1095-C for that retiree?
If you have a retiree that doesn't have Medicare and you are fully funded, you don't have to do anything with that person. If you're self-funded and that retiree doesn't have Medicare and they're on your self-funded plan, then you have to send them a 1095 because they're a participant on your plan.
Was that the right answer?
Okay.
This one's from Keith. So if an employee goes over 30 hours per week for 1 or 2 months but is under 30 hours per week for the rest of the look-back period, they would not need to get a 1095. Is this correct?
Correct, based on your measurement period. You need a, because when you get audited, they're going to come in and they're going to say, what's your measurement period? If you say your measurement, you have a written policy that your measurement period is 3 months, then that's what you have to go by. We always recommend take a 12-month measurement period, but then remember your 10-month employees, you can only use 10 out of that 12. You just take the 2 months that are summer out of the equation. So when you hire somebody, you have to do a reasonably expected to work evaluation of them. So I hire somebody and they're a full-time teacher and I reasonably expect them to work and they're offered coverage and they get their coverage and they're happy. I hire somebody and I say, wow, I'm hiring you long-term sub and I do really reasonably expect you to work over 30 hours. That person needs to be offered coverage because you reasonably expect them to work over 30. You hire somebody and you say, you're a sub and I don't reasonably expect you to work over 30 hours over my measurement period, which is, I'm going to do your sub, so it would be 10 months, and I don't think you're going to. I'm not going to offer you coverage, but I'm going to measure you. You measure them for your entire period. At the end of the period, then you're going to see whether that person averages over 30 hours or whether that person does not. Every year, you're going to measure all of your variable people. You measure them for your time period, and then you offer them coverage or you don't, and you continue measuring. So with this law, you could actually have people who 1 year they're on your plan, the next year they're offered COBRA because they're off your plan. You measure them, they could be on your plan. So it does add a lot of extra paperwork.
And to expand on that, one more example that I could see happening that I think maybe the question was is I hire a sub and I don't expect anything to happen. Then one of my full-time teachers goes out for FMLA and I've got to fill that void with one of my good subs. And for a 90-day period now they become a long-term sub. As long as I didn't reasonably expect them from day one to be that 30-hour worker and course of events change, I'm just going to measure them and calculate those hours throughout the course of that 10-month period of time and then see whether or not they qualify for the benefits that following year. So it should not stop your workflow, but again, I think the easiest definition should be that from day one when I hire you, what's my expectation? Do I expect you to work 30 hours or more? The best thing for you to do would be to offer coverage. If under 30 hours that I reasonably expect you to work, I'm going to track you.
Right, and where you may come into some issues is when you get audited and you're using that, and the IRS words are reasonably expected. So if you use that and you truly hire people and you're working them from day one over 30 hours and you get audited and they're going to say, how did you possibly not know that this whole group of people wasn't going to reasonably? So you truly, they're going to be looking for people who are not being honest with this, so you really don't want to play with it. It really has to be a true reasonably expected not to work.
And now to throw one more what-if scenario in there, and that is, I know schools hire some seasonal employees when the school's closed to run some programs for children. Again, those are seasonal. Those, as long as it's within less than 120 days that they're working and they're not coming back, they only work that summer for me, I typically I would not have to track them, and I would not have to offer them benefits during that seasonal period. But if they work more than 120 days, then I should be tracking them throughout the course of the year to see whether or not they measure.
All right, I'm going to jump in here. I have 8 questions queued up for you.
Wow. Nice.
All right, so if you're done with that, we're going to proceed on to the first question. This one's from Joe. Do you know if NYSHIP, even if it is self-insured, plans to issue an SBC to each participant this year?
NYSHIP, what we've heard, they send home basically the postcard, okay, that tells you that it's available online. Our best practice recommendation is in your personnel that you send out, once you get that postcard, you send out a blast email to all your employees and say that it is available. And I would also print some copies inside and keep them inside your personnel office so that when somebody comes in and they ask for a copy of it, you have it.
If you have a set of employees that don't have a work email or don't have that, then handing them out once a year is going to cover you, because that is something, that's $1,000 a day fine for not providing. And we're talking about the summary benefits of coverage if people aren't in, but those need to go out to all employees one time per year, and then to new hires. If you offer multiple plans, for new hires, you need to give them one for each plan that they have offered to them. For people who are on the plan already, you only have to give them the plan that they're on unless they ask for other ones, and then you have to provide those within a certain number of days.
Okay.
And again, another best, one more point on that. The best practice would be if you have an intranet, the other thing you could do is after that blast email and you have an intranet for all your employees to access, you can post it on the website and tell them that it's there. And that would be another way to show that you're doing best practice and trying to notify everybody that it exists out there.
Okay. Next question is from Melissa. We offer an employee paid plan for all non-benefit eligible employees. Since we have offered a plan, do we need to issue a 1095? The district does not contribute to this policy and is processed through a third-party vendor.
I guess from a question perspective, are they working 30 hours or more? And is it affordable? Would be two more points that I guess we'd need to ask before we could answer that question.
Okay.
If they're better than the law, if they're all 20 employees, I guess I'll answer it this way. If all they're working is 20 hours and you are offering them a plan and you know that, then you don't have to issue.
But if they're working 30 hours, you do have to issue them.
Right.
Okay.
You're going to need to track those people.
Next question is from Laura. What if the retiree has Medicare coverage and is also on our self-funded plan? Do we file a 1095-C for them?
They're an early retiree and they're covered under Medicare.
No, they're
regular retirees?
They're Medicare retirees.
If Medicare is primary, you're not going to do that. If your plan is primary, which it wouldn't be, Medicare would be primary. So you know you're not going to. Medicare, if they're over 65, you do not have to.
Excellent. Next question is from Karen. Our retirees are responsible for 100% of the premium, therefore it wouldn't be affordable. Will we be penalized for this?
Absolutely not. You're only judged on affordability for your employees and only your employees, so only single coverage. And those of you that aren't familiar with that, we're talking about affordability. For employees active, you can only charge them 9.5%, and you can choose by class of employees what you do the 9.5%, and it's 9.5% of either their W-2 Box 1, the federal poverty level, or their pay rate. So that's what you can choose them for single. You do not have to make it affordable for family coverage. You do not have to make it affordable for retirees.
And again, Matt, the best clear answer for that one would be your retirees are no longer your employees. Therefore, you're not being judged on affordability.
Excellent. And our next question from Stephen. Is the affordability calculation impacted if an employee's household income is less than 400% of FPL and they qualify for a federal premium subsidy, or if they are eligible for Medicaid?
No, your affordability is going to be off of one of those three safe harbors that we said. So in that case, if you're using the pay rate or the federal poverty level, whichever one you're using, affordability is just going to be based not on household at all, on the single person's pay rate or single federal poverty or their W-2 Box 1. You can't charge them more than 9.5% of that. Those are the safe harbors. They got rid of the whole family, looking at family income. That was a change in the law, an update.
Yeah, that part of the law was changed, and those safe harbors were introduced in 2011.
Okay. Next question is from Janice. We became self-funded effective July 1st. Do we prepare Form 1095 and Form 1094 for only the 6-month period?
Yeah, if you're fully insured, then you're going to do, so the first part of the year you were fully insured. So you're going to only do 1095s for your employees for the first half of the year, and you're going to do sections 1 and 2.
Right. And
the carrier is going to send Section 3 to them at home. Starting in July, when you became self-funded, you're going to have to do 1095s for all of your participants, and you have to do all sections of the 1095s from July to December. You have double the work, sorry.
All right, and our next question.
Not a good day. Not a good day for that.
It won't be a good year.
If a retiree is enrolled in a Medicare Advantage plan, who sends the 1095?
The carrier will be sending that 1095.
Excellent. Quick answer. This question is from Carlene. What would the measurement period for a coach only working 1 season be?
it's going to be the same measurement period that you have. You can do different measurements periods. If it was my client, I would recommend a 12-month measurement period. And if he just works one season, then you're just going to track him that one season for the whole 12 months, and you've got your tracking proven.
Okay, and final question that I have is from Lisa. Please define affordable coverage, because affordable coverage is not the same for everyone.
Exactly. Affordable
Because
coverage,
affordable,
remember,
excuse me.
affordable by federal law is 9.5% of there. You get to choose between their W-2 Box 1, the federal poverty level, or their pay rate. So you're going to choose that, and you can only charge them 9.5% of that for the year. So you're going to look at that and say, you have to do the math. It has nothing to do with what your premium is, or most cases that we look at, they say, well, we're going to charge 10% of the premium. So you have to do the math, how it equates to the calculation of their pay. And remember, affordability is only on the single lowest minimum value plan you offer. So if you offer two plans and one of them is a bronze level minimum essential coverage plan, low end plan, then and they buy up to the high end plan and they buy family coverage, it doesn't matter what comes out of their check. The calculation is always going on the lowest minimum essential coverage plan for single only coverage, because when you look at it, they're saying they have the option to get that plan, even though they don't take it.
Okay, and we have, oh, they keep coming in. Can I get more detail on the 3 different income factors? An example, we can use 9.5% based on the hourly rate. Can we use 9.5% based on the hourly rate?
Yes, yes, you can use 9.5% of the hourly rate. To do that calculation, you're going to assume they work 130 hours per month. So you just take that hourly rate times 130 hours per month, and then that's going to be your affordability factor.
Okay. Are coaches considered 10-month employees, or are they 12-month because they are seasonal?
Yeah, I know that when you get into a football sport, they typically start in August, so they're already, they're pretty much an 11-month employee from a tracking perspective. I would keep them in the 12-month tracking period, because you do have seasonal programs where these coaches will step in and do other things during the course of the year for that particular sport, prepping the team for the next year.
They may have a summer camp. They have the option to work, whereas a teacher doesn't have the option. Well, they could do summer programs, and then that would be a 12 months. So it really depends on your own individual. We would look at that on an individual basis and how you would answer that in an audit based on, do they truly have the ability to work?
Right.
Okay, next question is from Karen. This is in regard to affordability. When you have determined that a variable employee is eligible for coverage and they elect coverage, are there defined methods of collecting their share of the premium? Also, what if they quit working? How do you collect?
Yes, and that's the interesting part of the law. So you have somebody who qualifies based on their measurement period. Their stability period is how long they're allowed to stay on your plan. So if you have somebody who qualifies, you have a 12-month measurement period, they averaged over 30 hours, your stability period has to be at least 6 months or match your measurement period. So in the case of a 12-month measurement period, you're going to have a 12-month stability period, and you're going to collect their share of the premiums either through payroll, and if their hours get cut and they don't have enough to pay that, then you're going to have to collect it, which follows the same rules as COBRA. So you have to notify them. You don't have to bill them monthly, but you do have to notify them what their share of the premium is, when it's due, and you have to give them a 30-day grace. So if they don't pay it for 30 days, then you can cancel them. you keep them on that stability period until you terminate them as employees. So if you terminate them as employees, then you offer them COBRA, and they're considered a terminated employee.
Okay, and they keep coming in. This one's from Stephen. If I calculate affordability as 400% of FPL times 9.5%, am I covered for everyone?
If you use your federal poverty level and you do the 9.5% of that for everyone, you can use that for all classes of employees, yes.
Yes.
All right. This one is from Stephen. When looking at hourly rate, is it for each individual employee or the lowest hourly rate paid, i.e. a sub?
Yes, it is for my individual pay.
It's for,
Okay.
yeah, each people, because remember, and I'll go back to the copy of the 1095Cs, you put in that section 2 what their lowest cost would be. So based, if you're using pay, mine could be higher than Mike's, and then Matt's could be different.
Yeah, what we found typically is you look at each one of your units. Your first calculation should be look at your bargaining units, look at your lowest wage in that, and do that calculation of 9.5% of their salary versus what are you taking out for single premium in that class of employee, and see if it is affordable. That's a down and dirty look to see, am I meeting guidelines, am I not?
Right, and remember, in that box is not my lowest one, but it's what I would be charged if I took it.
Right.
So those can vary by your, typically we see it by the union contracts or the date of hire. So you may have teachers that were hired before 2001 pay X amount, and teachers that are hired after that pay this amount.
In a couple areas that we've seen some stress, I should say, from a district perspective is the contributions for cafeteria workers and bus drivers who they make eligible, and they do work the 30 hours based on their wage, making it affordable for them. So those are the two areas that you'd want to look at.
Okay. Next question is from Angela. We offered coverage to more than 70% of full-time employees during the look-back period. During the look-back period, we defined employees who worked more than 30 hours and did not have coverage. Is it illegal if we decide not to offer coverage to these employees during the stability period?
Well, this year we're in the 70%. So the law says I got transitional relief. So I had to offer to 70% of those that average 30 hours or more. If I am meeting that guideline, I get transitional relief, and I could not offer to them. Worst case scenario is I could be exposed to a $3,000 penalty should one of those employees go out and get a subsidy from the exchange. We haven't seen a lot of activity with a lot of employers yet where they're going to the exchange is coming back and checking with the employer, but we'll start seeing that happen in the next year or so. So the quick answer to that is, as long as you meet the 70% guideline, you could choose not to offer to them this year. Should somebody go out and get in an exchange and get a subsidy, you could be exposed to the $3,000 penalty for that person. But next year, we're going to be at 95%.
Okay. Our next question is from Antoinette. This is in regard to the 1095 form. We have different contribution rates for different units within the district. Does Part 2 of the form need to be individualized for each employee?
Yes, based on hire date.
Based on contribution.
And contribution, and yes, because typically most union contracts will be, they sunset at a hire date that the new hires after this date pay X% more. So those after that hire date will have a different contribution for the single rate in that box.
Great. And this is from Ann. If we give health coverage to employees who are not full-time, do we have to file a 1095?
No, only if they average 30 hours or more per week based on your measurement period. You only report on the full-time employees, and again, full-time is 30 hours according to the federal government.
Okay, and the last question I have is from Lisa. Can I offer a less expensive plan for only those individuals not covered on our collective bargaining unit?
Yes. Get one in today and get that other agreement in for all your other bargaining units.
Yeah, the best way, and we do have several districts who offer minimum essential or bronze or low end. As long as it's minimum essential coverage plan, you can offer that. If you can get it into all your districts at a lower rate than you or all your unions, then you can actually use that for affordability on everyone. So if your unions won't let you put it in, absolutely you can offer them a separate plan. But for ease of just getting this through, doing this paperwork, you can absolutely do it through just those who aren't in the unions.
Mm-hmm.
What we do, we use a system that tracks everybody. So we take an upload from your payroll and information on your union contracts and your information from your carrier, upload it to a system that tracks the hours so it's all right there and auditable, and then produces the 1095. So it fills in all those little boxes based on the information. So it makes it a lot easier.
And we'll also do the transmittal. But now to even complicate it, as we think about adding that high deductible health plan to qualify for the affordability, then we look at the other side of the tax or the law that's coming up in 2018 that you should be thinking about, and that's the Cadillac tax. The Cadillac tax has nothing to do about the affordability calculation. It is separate and distinct part of the law. The Cadillac tax is what plan am I enrolled in. And so if my premium is over $10,200 for an individual or $27,500 for a family, the way the law is currently written, it is an employer tax on 40 cents on the dollar. It does include FSAs, flexible spending accounts, even though it's the employee's money, that $10,200 threshold. It includes AFLAC plans like a hospital plan, a specific disease, forgetting one, but it'll come back to me. Also an HRA, health reimbursement account, and a cancer plan, specific disease, cancer, and hospital plan. If those are pre-tax contributions, those all account up to the $10,200. And any dollar over and above that, the district would be subject to a 40% excise tax.
Mike and Kirsten, this is Deborah. We have about 5 minutes left, and I know we've had a steady stream of questions. We'd love to keep those coming, but we know we have time limits. I'm thinking keep the questions coming. We will keep track of them. We will share them with Mike and Kirsten. We will get answers. We will also consider whether we need another hour to address some of these questions, but perhaps in these last 5 minutes you would just want to wrap up and hit some important points that you would like everyone to be aware of.
Right, yes. And the main point, I mean, we can get into Cadillac tax, and that's a whole nother hour conversation. We have a lot of clients with NYSHIP, and I can just tell you that we've done the calculation, and NYSHIP absolutely hits the Cadillac tax, so it is something that you want to prepare for. But back to the compliance that you really have to right now be aware of is making sure you have your policies in place, making sure you're giving out that notice of exchange for new hires, you have written policies for your measurement, and you have proof that when you go to get audited, when you do get audited, that you have proof you have a measurement period and that you follow it. Mike and I, our association, like yours is NASBO, ours is New York Health Underwriters, so we go to a lot of seminars that are given by the Treasury and the IRS that say, this is how we're going to audit, this is what we're going to audit for. Obviously, if you don't do your 1095s and 1094s, you're going to get caught. So you have to do that this year. The systems that can do this, you can go to your payroll company. We work with Finance Manager and we take uploads from them. Finance Manager will only produce these forms for you if you have all of the information in their system. So if you are one of these great districts that have all of your dependent information, all of your how much people are charged, not what they're charged, but the affordability based on what they should be eligible for, then you can probably get your payroll company to do this. The districts that we've talked to don't have the time or the energy to put all that information, so ask your carrier or your payroll, can they produce them? If they can't, you're going to have to look for a standalone company or do it yourself. So if you do it yourself, remember you've got to check all those boxes and make sure that you have somebody in your district that's able to keep up with that, or you hire an outside vendor. We're one of them that can do that. There's other vendors out there that can do them. Just make sure, because most of them have a deadline of October 1st for you to sign up, because it's a lot of information to gather and it takes time to get these produced. So make sure whomever's in your district is on this and you have somebody that's going to produce these for you, because the fines are huge.
Yes, and Deb and Matt, you know, we would be absolutely happy to do another hour or however many you'd want for us. Bottom line is we want everybody to feel comfortable about their obligations and what they have to do, because as you can see, they just raised the fee. They hit it in the trade bill, passed it, to raise the fee from $100 per employee per day to $250 per employee per day. So they are serious about this, and I don't think any district, when you get your funding from your taxpayers, would want to see that in the paper that you get pinned for a $3 million fine.
And as a nation, we have spent so much extra money on these subsidies, and we're so far below or above the budget that we have to collect monies from somewhere to pay for the subsidies we've already gotten. So even if you think, well, the election's going to change it, which is after they're due anyway, either side is not going to do away with this simply because we're already so deep into it. So we need to prepare like it's written today. Here's a slide that has our information on it, so anyone who has any further questions can give us a call or send us an email.
And we will answer, Matt, as you're collecting, and Deb, as you're collecting the additional questions, shoot them over to us. We'll answer the questions, send them back to you, and then you can get them to everybody.
Absolutely. If anyone would like to review the webinar after today, I will be posting it on our School Business Connect site within the next hour. And Mike and Kirsten, thank you so much for presenting and answering all the questions today. And we will definitely look into providing at least another hour of instruction programming on this topic for everyone else that is still